Retirement often brings about a shift in our investing goals. We're likely no longer adding money to our accounts. Instead, we're probably making steady withdrawals from them, which may mean our investments as they stand right now might not be sufficient to meet our goals. So, how can we get our investment portfolios retirement ready? It all starts with evaluating our current investment portfolios. One way to go about it is by looking at what you're invested in and where those investments are sitting. In other words, reviewing your asset mix by figuring out how much is invested in each of these categories: cash, fixed income, and equities. This is your what. To assess the where, look at which types of accounts those investments are sitting in. In a previous lesson, I talked about some different drawdown strategies typically used during retirement. And the strategy you choose will play a big role in determining your portfolio goal. So check out that video if you haven't already and see where you might land. Let's run through an example. Claudia has recently retired at the age of 60. She estimates that during her retirement, she'll need to dip into her investments to help cover expenses during 2 time periods. She'll need at least $4,200 between the ages of 60 to 64 and at least $13,100 between the ages of 85 to 95. As for her investments, she has a registered retirement savings plan, or RRSP, worth $20,000 and a tax-free savings account, TFSA, worth $60,000. Based on her expense estimates, she decided to use a modified bucket and percentage drawdown strategy. Because her expenses are expected to be low from ages 75 to 84, there are only 2 periods of time she'll need to withdraw money from her investments, so she'll have 2 buckets. Her first bucket is her RRSP. She plans to withdraw 20%, or around $4,200, every year from this account for the first 5 years of her retirement. Her second bucket is her TFSA. Between the ages of 85 and 95, she plans to withdraw 10%, or just over $13,000 a year. Now, let's look at where her investments currently stand. Her RRSP is made up of 80% fixed income and 20% equities, and her TFSA is made up of 70% equities and 30% cash. Can you spot the potential risks? Let's start with her RRSP. Claudia's goal is to make annual withdrawals from this account to boost her income until her old age security pension starts at age 65. The potential risk here is that Claudia has no cash in the account. You might be thinking, well, she can just sell investments as she needs the money, which is true, but what if the value of those investments goes down? Since she doesn't have a lot of buffer in her budget, this means she'll have minimal time to wait for them to rebound. To reduce this risk, Claudia can prioritize her guaranteed access to her money for, let's say, 2 years by selling at least 40% of her current investments. She can keep the proceeds in cash or put them in a money market that can pay slightly more in interest. And because the sale would be done inside an RRSP, there'd be no tax consequences. If this had been a non-registered account like a cash or margin account, she may want to consider tax consequences of selling her investments. And over the next couple of years, she could choose to leave the remaining 60% of her assets in high-quality fixed income products expected to mature or convert to cash in 1 to 2 years. This can help ensure that she'll have access to her cash when she needs it, but that it can earn a little more interest until then. Now, let's look at her second bucket, her TFSA. She doesn't plan on dipping into those funds until she's around 85 years old, when she expects her medical and residential costs may rise. The potential risk here is that inflation could devalue the cash Claudia is holding in this account. Plus, cash balances may not earn a lot of interest, if any. So, Claudia may be missing out on 25 years of returns, which could otherwise be reinvested, creating a snowballing growth effect. Now, since she doesn't need the cash from her TFSA anytime soon, she can choose to invest it. And since her account is already 70% invested in equities, she could consider investing some or all of her cash into fixed income. Because her cash would be invested for such a long period of time, she may want to consider the risk of inflation devaluing her cash when she's finally ready to access it. To reduce this risk, she may consider investing her cash in short-term fixed income products that she can continually reinvest when they mature. This means that she locks in her rate of return over a shorter time frame, helping reduce the risk of inflation. And since she won't need to withdraw from her TFSA until she's 85, she can consider changing her asset mix to cash and short-term fixed income a few years before that. So, to recap, Claudia's retirement portfolio makeover could look something like this. The asset mix of her first bucket of investments, her RRSP, is 40% cash and 60% short-term fixed income. And the asset mix of her second bucket investments, her TFSA, is 70% equities and 30% short-term fixed income. Making these changes can help optimize Claudia's portfolio throughout her retirement. When you're looking at your own portfolios, remember, one size doesn't fit all, and this isn't a one-and-done exercise. The combination of your retirement budget, investments, risk tolerance, and tax situation is likely to be as unique as your fingerprint. And as you move through the different stages of retirement, your expenses and even your risk tolerance may change. So it might be a good idea to regularly look at your goals, see if they still apply, and adjust your portfolio accordingly. Now that you've seen an example of how to optimize your investments for retirement, check out your own portfolio to see if there are any changes you can make to help set you up for the long haul.
Have more questions? Check out the links to the right and in the description below.